I'm Ryan Lightfoot-Brown of FundCalibre. We're joined today by Stuart Springham, the elite-rated manager of the TM Home Investor Fund. Stuart, thank you very much for joining us.
Thank you for having me, Ryan.
And I hate to bring up the dreaded B word, but Brexit has been an ongoing issue, especially for the housing market. It's been putting off people from sales and purchases. Has that impacted the fund at all?
I think, in short, yes and no. As mentioned earlier, we're a total return fund, so we're relying on capital growth and rental income. Capital growth has been stagnant over the last year, so we've got that side of it. You know, the market's only increased 0.8% over the UK in the last year, which is not great as far as the UK housing market is concerned. What it has done is impact the inflows into the fund. We've not had any big redemptions, but the inflows have slowed. We are £3 million. Our AUM is £3 million higher than it was a year ago. But I think the main key one within this is that the residential market is very resilient. There's still 60 to 80,000 transactions a month, even though it's on average 25% below during sort of over the last 3 years because of Brexit. That's still a huge number of transactions. If you break it down to 15,000 a week, the market is still very much ticking over, especially outside of London. People still need places to live, they still need places to buy. And I think the key stat also is that 10,000 new homes are being built every single month still and registered with NHBC. So there's a huge pool for us to look into, to buy into. And you know, we've only got 200 houses versus all these transactions that are going on. So we are a small percentage of the market. So yes, in short, it hasn't really impacted us at all. And rents are still increasing. They're still in line with inflation and still in line with wage growth. So we've still got very good income and return on that side of the fund.
So with that sort of Brexit uncertainty you've managed through, but in case if we do, as many people are speculating, come up to a recession, do you think the housing sector can still be resilient through that, considering what happened in 2007, 2008 and onwards?
Well, actually, it's a bit of a myth. The residential property market is a lot more resilient than people give it credit for. I mean, if you compare it to equities, bonds and the commercial market, for example, in the real drop in 2008, the residential housing market only fell 13%, whereas the commercial market dropped 36%. And then the resi market reacted and got back to its base levels twice as quickly as the commercial market. So it really isn't impacted as much. And as I said before, the transaction levels are still very high. People need places to live, they need places to stay. And I think one of the key points here is, even in that huge crash, the government is always under pressure to bolster the housing market. And even if their reactions are to drop interest rates as they did last time, or bring in the help to buy, they're very keen on maintaining the housing market. And I'm not sure we'll ever see the big dramatic falls that we did before, say in the 1930s. But even then, in the Great Depression, it only dropped 20–25%.
And clearly recovered.
Yeah. And I think, as I mentioned earlier, that income, for us, the income or the rental will always stay pretty resilient. And I think there's a key statistic I read recently by the RSES in their end-of-year report, was that buy-to-let investors, the standard buy-to-let investors are falling away from the market, that the tax changes that were brought in by George Osborne is really hitting. And so these investors are falling away, whereas there's increasing demand from renters. So there's a real sort of supply and demand problem in the rental market. So for us on that side, I think that we're really going to see good returns, even through a recession, if there is one.
And UK property funds have been under pressure of late with things like redemptions. How do you manage your cash reserves and any potential redemptions?
Yeah, I think the key point here, Ryan, is the fact that as I've mentioned earlier, the commercial market is a lot less resilient than the residential market. There's a lot more transactions. Our property values are only £250,000. So the liquidity is a lot more there versus a £30 million commercial building, whereby a commercial fund will have 10 properties valued in the hundreds of millions. We've got 200 properties at £250,000. How we manage that liquidity, within our prospectus, we aim to have between 10 and 15% cash. We had some really good inflows leading up to the end of November, and we got over 20% cash. So the investment committee there and then authorised deployment of cash. After the election result, they then agreed that we would deploy more cash, into the Boris bounce. But I think the really key point is that we're very open and honest with our main investors as to what we're planning on doing and also what they're planning on doing with their outflows. And I think as long as we keep that relationship open and symbiotic, it's very easy for us to manage that liquidity redemption flow.
And with that in mind, what sort of income are you generating for your investors?
So at the minute we've got a 4.6% gross return, which nets off to 3.2%. And as part of the asset management, the investment committee's decided that we're going to try and sell off some of our flats because some of them are 7-8 years old and service charged, and the ground rents have started to increase, which obviously is hitting our leakage. So we're doing a sort of a shift from houses to not totally, but we're trying to sort of sell off some of our older flats where the net return's not as good, and buy some houses where the costs are lower, and we can target sort of 20 to 23% leakage on those and just get a better return for our investors.
Okay, Stuart, that's been really interesting. Thank you very much for joining us.
Thank you very much for having me.
And for more information on the TM Home Investor Fund, please visit FundCalibre.com.